The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's flying higher than one of Elon Musk's rocket ships. It's Anthony Macdonald. How are you, Anthony?
Looking forward to doing this podcast from space one day, James.
Fantastic. Well, this week we ask whether Elon Musk can pull off one of the biggest share market floats in the history of this planet and any other with his SpaceX venture. We examine how the budget aftershocks are hitting the housing market, and we jump into our overflowing inbox and tackle your questions on the government's controversial budget tax changes. But first, Anthony, we've got a surprise this week from the latest data on the jobs market. Now, economists had expected Australia would add about 15,000 jobs in April, but instead we shed 18,500 jobs, sending the unemployment rate a touch higher to about 4.5%. Anthony, is this good news or bad news for the economy? And the other part of it, is it good news or bad news for the RBA's fight against inflation?
I think you want me to say it's good news, James, but I just can't do it. I agree. The unemployment rate rising, I agree. Not a good thing, just generally. You know, the number of people in jobs dropping by 19,000 in a month, it's not a good result. Does it ease pressure on inflation and inflation problem? Yeah, sure. I mean, has it eased expectations of interest rate rises? Absolutely, but I'm still not saying it's good for the economy.
No.
You know, good would be if the number of jobs grew, the economy grew, prices didn't spiral out of control. And that only happens if you have productivity. That lowers the unit labour cost. It means that companies can put through wage rises without prices increasing. That would be good for the economy, but we're not there. We can't grow at 2%, let alone more than 2% without inflation being a problem.
Yeah.
And so we are where we are. So yeah, this softer reading, I mean, it does ease pressure on the RBA and it shows that the economy is cooling. But I mean, unemployment, for context, it's still 4.5%. It's still a tight jobs market. It's below what the RBA would say was a sort of stable or neutralised rate. So the slowing down seems to be working, but the economy's still got its issues, I think.
You're exactly right. This is a reminder that we are going to get, one way or another, the slowdown that we have to have. You know, there's no other way to tame inflation than slowing the economy, and falling jobs is a signal that the economy is losing momentum. The stock market might have celebrated that because it means rate hikes might not be as numerous as they thought a couple of days ago. But the Australian economy losing momentum is not good for domestic stocks. It's not good for most of us as we try and figure out where the economy goes over the next, not just the next year, but the next few years. I remain pretty worried about this, that we could see the worst of both worlds, where inflation's enough of a problem where the RBA has to keep hiking, but we get the cracks in the jobs market and the slowdown in the economy at the same time. You know, you get that stagflationary sense, which is not going to be very nice. So I think this is a real watch for the RBA and for everybody.
Yeah, James, while we end the week debating the outlook for the official cash interest rates, we spent much of it thinking about where rates are going in financial markets.
Yeah.
So bond yields, and they're the interest rates that governments offer to entice investors to lend them money so they can spend it on hospitals or schools, roads, statues of former Victorian Premier, your hero, Dan Andrews, James.
Yes.
I mean, these bond yields have been rising sharply right around the world, sparking fears that a red-hot share market could be set for a fall. James, we talk about the share market a lot, but the bond market is actually a lot bigger and it's traditionally been seen as more important. Can you tell us a bit about how the bond market works, why it's important, and why everyone is so worried about those rising bond yields now?
Yeah, well, I think the way to think about the bond market is that it's a place where governments and companies and other institutions go to borrow money for all sorts of things. Sometimes it's because they're going into debt. Sometimes it's just so they can have cash to make normal things work. So the government goes there, or a corporation goes there, and it offers an interest rate. You lend me $100 and I'm going to pay you an interest rate of 3.5% a year, and then you'll also get your money back. Sounds like a pretty good deal. Investors can choose whether they want to lend the money or not to that borrower. And of course, governments traditionally have been seen as the safest borrowers because they've got these magical printing presses that allows them to keep printing money. Now, what happens when bond yields rise is that's a signal that there's a bit of concern or investors are demanding a bigger risk premium for the privilege of lending that money. And what we've seen this week is that bond yields have risen quite sharply around the world, everywhere from America to Japan to Australia to France to Britain. All for slightly different reasons. Obviously, in Australia, we've had the budget. In the UK, for example, there's a prime ministerial crisis going on. Keir Starmer, the prime minister, looks like he's going to be tipped out at some stage. But underlying all this is two common issues across all these countries. First, most governments have got too much debt. So investors are demanding a little bit more return to lend money to those governments. And second, investors are worried that inflation is getting out of control. It was already sticky and now we've got the energy shock. So again, investors are demanding a little bit more premium to lend money to governments. So that's what we've seen. But those bond yields, particularly a bond yield like the US 10-year government bond yield, it flows through to everything. It affects the price of money all around the world. And so the money that you pay on a car loan or a home loan or a business loan is affected by how that 10-year government bond yield works. So that's what makes it so important. And that's why everyone gets a bit skittish when bond yields start to rise as they have been, particularly in the share market. If you think of what the share market does, it values companies based on their future profits, uses what's called a discount rate to discount the future profits off into the 10 years, 5 years, however many years into the future. The bond yield helps set that discount rate. When bond yields rise, you discount future profits by more, and that means you should logically pay less for a share, and the equity markets fall. We haven't really seen that, Anthony, so far, because everybody's betting on this AI boom to run on. But the question is, do rising bond yields eventually start to whack equity markets and hit Wall Street and the ASX? And I think that's what everyone's watching, right?
100%. That US 10-year rate that you talk about, I mean, that's the number one thing that fund managers would look at in Australia when they wake up every morning. It is the number that sort of sets the tone for the whole market. It's at 4.57% today. Above 5% is very hard for equities. That 4.57 has been rising recently. But yeah, just generally, bond investors worry about inflation. Equities investors look for growth. Sometimes they're on the same page. Sometimes they're not. So we just kind of look at when that sort of flips between those two, when they converge and when they get apart. And at the moment, the bond investors are saying, hang on, let's worry about inflation. While the equities investors are still saying, you beauty, earnings are growing. We're onto a good thing here. So the bond and equity investors are on different pages, and we've just got to see whether they come together or get further apart. And just quickly, James, we can't let this one pass without mention. One of our favourite lunchtime topics, Guzman y Gomez, is pulling up stumps in the US. The stock's up 15% on Friday morning, right? Pulling out of the US. This is supposed to be a bad thing. The company's talking to investors right now as we speak. What do you reckon, James? Is this good news or is it bad news for the US who won't get to see an Australian company reinvent their pet industry fast food?
Look, Guzman y Gomez, their American adventure was pretty limited. They went to Chicago. They opened 8 stores. They tried to make it work. One of the co-CEOs, Stephen Marks, he's been living over there for the last 3 months. Feels like he had a last roll of the dice to get this going, and it's just not getting the traction they need. And they're losing money on it. So they've made the decision to sort of stem the bleeding, I guess, and investors are pretty pleased. Everything's changed for Guzman y Gomez. They came into this, their much hyped float a few years ago. The US was part of their growth sizzle, and now that's gone. But I think that's probably the right call because the story's changed. Nobody sees this as a growth stock anymore. They hope there's a bit of growth there, but it's not going to be spectacular. It just needs to be priced as what it is, and I think it's coming back to reality, isn't it?
Yeah, I mean, I agree with you and I disagree with you a little bit. I mean, I wouldn't say that nobody sees growth here or priced as a growth company. I mean, the Australian business is still growing. Australian network sales will be up this year. Australian network EBITDA is supposed to be up about 25% this year. I mean, that's good. But yeah, I agree with you completely that at the time of the IPO, the sizzle was the US. I mean, that's where the big bang growth could have been. It's not going to happen anymore. In a way, credit to GYG for pulling up stumps. It's what sort of investors have been looking for. In another way, kind of sad for an Australian business. They go and try something that could have been revolutionary. Didn't quite work. So, hunker down and focus on what does.
I think a bit of credit to them. This is what we want businesses to try and do, to go out there and try some things and then be honest about it and say, didn't work, we're pulling back. They had a crack. That's what we want to see in Australia, people having a crack, I reckon.
I reckon too.
Okay, Anthony, let's move to our first topic. And I've never quite seen anything like what we saw on Thursday morning. Everyone in financial markets was very excited about NVIDIA's quarterly earnings, which promptly arrived about 6:30 a.m. our time. And they were spectacularly good. Profit rose 211% to about $58.3 billion US. And that's in the space of 3 freaking months. It's a hugely profitable company. But for once, the world's biggest company was just the entree. Within the space of, about 4 hours, we learnt that OpenAI is racing towards a share market float. Anthropic's quarterly revenue has doubled, and it's almost profitable as it races towards the share market float. And then we got the big one. Elon Musk's SpaceX is set to float in a deal that will probably value the company at more than $2 trillion. Now, Anthony, please tell us what SpaceX is. And why the hell is it worth so much?
Well, it was founded by Elon Musk, a name everyone's probably familiar with now, 2002. He's the man of Tesla fame. He's the CEO, chief technical officer, chairman, major shareholder. He is SpaceX. So this company is building hardware and software infrastructure, it says, for a future across space, connectivity, and AI, which is a real sort of bunch of jargon mashed together that basically just spells hype.
Yeah.
It launches rockets, James. It sells broadband. It owns Starlink. I mean, people in Australia might be familiar with Starlink. That's the broadband provider. It provides it via satellites rather than cables in the ground. And it's operating in 164 countries. And then the big thing is it owns this thing called XAI. It was founded in 2023. That's one of the big AI frontier models that Musk started up, which owns Grok. People have probably heard of Grok. It's like Anthropic's Claude or OpenAI's ChatGPT. SpaceX and XAI came together late last year to create basically a big-ass tech company that's kind of part space, part connectivity, part AI. And AI, it's going to make the space possible because of the AI's power. Yeah. So it's all very Elon Musk, James, in the same way that Tesla's kind of part car maker, part batteries company, part automation technology. It's really focusing on that data, AI, wants to put data centers up in space. And that's what it's spending most of its CapEx on, data centers today. The numbers are huge, James. Like the valuation's giant. This thing's only really just getting started, though. I mean, it generated about US $20 billion of revenue last year, which is a lot of money, but it's not for a supposedly $2 trillion company.
Yes, good point.
You picked this out in your column. Like the most stunning number in that prospectus was what it says is the total addressable market at US 28.5 trillion.
Yeah.
And the bulk of which is AI. Like that is giant. It is saying that if it reaches its potential, it is competing for $28.5 trillion US of revenue. That's just nuts. But look, there's lots of cool space picks in the prospectus. I'd recommend it for anyone that's interested. This is by far the biggest IPO ever in the world, 2 times or more bigger than the next big one. It is the biggest show in capital markets globally. And it's all a bit of a fantasy, really, because, while we sit in traffic on the way to work every day, or most of us put petrol in the car, we burn coal to make power still, we eat meat, vegetables, and grains, just like our ancestors all did. This thing is saying, think about a world that's just bigger than that.
Yeah.
Right?
Yeah.
And maybe it happens, maybe it doesn't, but at the guts of it is this AI frontier model, the Grok. I mean, that's the real powerhouse that people are going to latch onto, I think, in the near term. So, James, like Elon Musk, he talks a big game.
Yeah,
and there's
totally.
a huge game being spoken through this prospectus. Do you reckon SpaceX is going to blast off or misfire?
Oh, I think the float will probably go pretty well. And it'll be hugely hyped. The interest from retail mum and dad investors across the world will be huge. Everybody will want to get in on the next big thing. So it won't surprise me if, in the first few days, this float really takes off and shoots higher. But I think the longer term questions are definitely there. As you said, the total addressable market that SpaceX is claiming is US $29 trillion. That's the same as what America's entire GDP is. These total addressable market figures are notoriously rubbery, but this to me feels like jelly on a paper plate. Like they are just guessing at what this business can do and chucking some numbers at it and hoping it sticks. You know, of that $29 trillion, $2.7 trillion is data centers in space. Now, no one's ever put a data center in space or got even remotely close to it or even had the technology plan that could even consider doing it. But yet, there's $2.7 trillion. Lock that in. I think $22 trillion of the total addressable market comes from, in inverted commas, enterprise applications, which is completely unexplained in the prospectus. Seems to be selling AI stuff to companies is the best description I can come up with. Now, yes, there's plenty of companies, OpenAI, Anthropic, they're all trying to sell enterprise applications in AI too. Is there enough market that it's big enough for everybody to get in on? Is it really $22 trillion worth? You can almost not argue with these figures because they're just so huge. They're almost incomprehensible. But for all that, Musk is such a good salesperson. You know, I sit on these Tesla calls every quarter. He talks absolute dribble. Absolute dribble. He rarely addresses a question in any detail, and it's all about humanoid robots, autonomous cars. And he gets on these calls, and he's been promising the same thing for about 3 years.
Yeah.
And everybody just eats it up. So I think everyone will eat it up again. I think there's lots of interesting questions around this. Musk has 85% of the voting control. He's the CEO, the chairman, and the chief technology officer. Mm-hmm. Oh, and by the way, he's also running Tesla. I mean, I don't know if there's 2 or 3 of the bloke, but it's going to be a pretty hard job to control 2 multi-trillion-dollar companies. So that's an issue. There's issues around whether space generally is quite as attractive a business as Musk thinks it is. But let's just watch the hype machine over the next month or so. It's going to go into overdrive. And what's interesting, Anthony, is that there's not just one of these big IPOs, SpaceX, but there's also OpenAI and probably Anthropic heading for markets. Now, nobody loves an IPO more than you, but 3 mega IPOs in the space of what's likely to be a few months. Is that the sign of a boom or a bubble?
It's definitely a boom. The biggest IPO before these was US $25 billion for Saudi's Aramco, the oil company.
Yeah.
I mean, this one will be 2 or 3 times bigger than that. Anthropic, that's the really red hot one.
Yes.
You know, with about a US $1 trillion valuation now. OpenAI was a bit hotter than Anthropic, although that's kind of fizzled a little bit in terms of that hype, at least in the past 6 months. You know, there's fears that OpenAI's ChatGPT hasn't kept up with Anthropic's Claude. But you've got these 3 whopper AI companies, right? At the moment, they're in private hands. They've been attracting lots and lots of capital in private markets. They've been doing funding rounds that are bigger than the biggest IPOs. People are just throwing money at them, and they're all eyeing public markets at the same time. I think that's a good thing, James. I mean, this is reaffirmation that public markets is the long-term home for big businesses, right? Just that ability for them to turn over their registers, for shareholders to recycle in and out. I mean, private markets, for as far as they've come, they just can't match public markets for that daily liquidity, and it sets up companies for the long term. But if all these do come to the market at the same time, James, I mean, it's got to also be the sign of a bubble.
Yeah.
I mean, if they can raise US $100 billion between them for IPOs, mind you, they're raising more than that in private markets, but it'll be more than US $100 billion. They might raise US $200 billion between them, US $300 billion. I mean, that's an absolute rush at big valuations. We never, ever seen that before. It's impossible to justify the multiples based on historical or 1 or 2 year, 3 year forward revenue or earnings, all of which spells bubble. But the question is whether it bursts or how long it goes before it bursts, how big it gets before it bursts. And let's just watch how these things go. I mean, they're monstrously big companies already based on their private market valuations. Like I said, they're the most valuable companies ever.
Yes.
I'm not going to sit here and bag them though, James. Like, you know, I reckon 2 years ago when NVIDIA was going on its massive run, we all thought that was in bubble territory, right? When its shares took off, and they're 2.5 times higher now, right?
True.
And like you said, their revenue and earnings is actually catching up to it. And it turns out there's massively strong demand for its products, which we sort of didn't appreciate a few weeks ago. You know, like its revenue in March, US $90 billion. So just in the quarter, in 3 months, that's more than BHP does in a year. right? So you got the biggest miner in the world, one of the best miners in the world, doesn't make as much revenue in a year as this NVIDIA does in a quarter, right? And it's still growing. Net profit's supposed to be up 80% this year. So it's growing like a weed. So it's stunning to watch. I'm glad I'm not a fund manager that has to actually decide which of these companies to allocate capital towards, because that's a very different prospect.
And that's going to be a big issue because these companies are going to go straight into share market indices. And that means fund managers, they're going to have to sell other companies that they might love to buy these things and keep up with the market. So it's going to be an issue. I think you're right, Anthony. Investing in bubbles is usually fantastic for investors as long as you know when to get off the train. And that is the tough bit, I think, here. This could keep running for a long time or it could keep running for a short time. Nobody knows. That's the fun of investing, I guess.
Yeah, James, just before we leave the topic of AI, I wanted to ask you about this guy, Bill Winters, the CEO of a bank called Standard Chartered. This week, he announced that he will sack 8,000 staff, but it was the phrase he used that caught my eye. He said he'll use AI to, and I quote, replace low-value human capital. Ugh. James, does that sound as bad as I think it sounds?
Oh, when Bill Winters retires, the first thing it'll say is Bill Winters, who once described his staff as, quote, low-value human capital. This is a quote that will follow Bill Winters around for the rest of his life. When we start cutting jobs in Australia for AI, and we will, I don't think any CEO will be dumb enough to use the low-value human capital descriptor for their staff.
Yeah.
But I reckon Bill Winters has done us a bit of a favour because this is what's coming. Now, Winters says that the cuts are coming in areas like human resources, compliance, risk management. If you think of a bank, we've said this before on the podcast, banks are ripe for AI because they are very process-driven, very rule-driven, very data-driven. It's the perfect combination. Winters is saying the quiet part out loud that there are jobs inside big organisations like banks that are at risk. And that risk is not something that's a long way into the future. It's something that is in the here and now. I think we've sort of got to be ready for that. You look inside our own big banks, they're moving from the experimentation with AI phase to the deployment at scale phase. They're just getting themselves ready for that. They have to cut costs because mortgage growth is drying up. There's not much growth in the Australian economy. Cost cutting is going to be where it's at. I think Bill Winters has reminded us of that. But man, you'd think these guys do a bit of media training or, someone might have said, oh, Bill, are you sure you want to describe it like that? What a mistake.
Yeah, I think he just called it like it is, didn't he, James?
Lots of us out there will be seeing low-value human capital and they'll think, oh, well, that's not us. I'm high-value human capital. But this is the thing about AI, it eventually can come for all of us.
Yeah, he might find himself low-value human capital one day, James.
Perhaps.
Okay, James, let's get to our second topic. And the political bun fight over the Albanese government's fifth budget rages on as the merits of the changes to the taxation of trusts and capital gains and the new negative gearing regime are fiercely debated. But as always in Australia, one topic rules all, and that's housing. Morgan Stanley this week declared that the largest house price correction in 40 years is underway on the back of the budget. James, is it really that dramatic?
Well, let's look at the Morgan Stanley maths, and this has been done by a team led by their economist and equity strategist, Chris Nicol. He says the maths is pretty simple. If you're a property investor now, you need a drop in house prices of between 15 and 20% for property investment to make sense under the new tax settings that the budget's ushered in. Okay, so there will be a pent-up demand from owner-occupiers and new builds that offsets that to some extent. So Nicol comes up with a number that says house prices need to fall by about 5% for the market to sort of reset to what he calls this new equilibrium. I think that sort of makes sense. But then you add in the fact that the RBA's pushed through 3 consecutive interest rate rises, will at least do one more, according to the market, maybe 2. And what we're looking at, Nicol says, is a drop in prices of between 5% and 10%. Put that in context, Anthony. Median house price in the last 5 years, it's up 53%.
Yeah, okay.
So we can take a drop of 5 to 10%. In fact, that's what the government is trying to engineer here, if they were brutally honest. But I think this is still a pretty big moment. Nicole's right. It's the biggest housing correction in 40 years. This is the end of what Morgan Stanley calls the 30-year housing supercycle, which has been built on tax breaks that the budget is attacking, and it's been built on cheap credit. That era appears to be gone. Inflation's sticky, interest rates are going to remain high. So this is a big change for Australia, I think. House prices are a national obsession, and you can understand that this change is just starting to filter through the market, I think. Anthony, I went to a big business function on Monday night, and there was real frustration still about the budget there. Did you sense the same at the AFR's Director Awards this week? And what do you think's keeping the budget, top of mind for business people? Why is it still so red hot?
I agree it's red hot, but it wasn't really mentioned at the Directors Awards, James. That was a seriously unique event. It's so inside that directors bubble. Lots of love in the room for directors. No one mentioned negative gearing or CGT. There was just a lot of, pats on the back and talks about career journeys and that sort of stuff, which is all important, but it was a sort of fascinating look inside the director bubble there. But on the outside, yeah, I agree with you, James. It's absolutely red hot.
Yeah.
And people just really don't like the prospect of paying more tax.
Yes,
the tax
true.
system's been pretty settled since the GST came in 25 years ago. Negative gearing and the CGT discount were in before that. So change always frightens. I mean, change after such a long time of stability frightens even more.
Good point.
And it's amazing how quickly people forget some of the big issues we were worried about not long ago, like housing prices, and when it might prove a little bit more costly.
Yeah.
So, like you say, Morgan Stanley says could be the largest house price correction in 40 years. I mean, isn't that the point?
It is, totally.
If housing affordability was a crisis, and we've called it a crisis repeatedly on the pod for probably 3 years now, how else do you fix it other than bringing prices down?
Yeah.
You can build new supply, sure. The government was supposed to be doing that. It's not working. So, I mean, what are they going to do, right? They're trying to knock it on the head.
I agree with you, Anthony, but I think people are starting to realise, what comes next? What's the next arm of prosperity in this country? And I think that's the bit where business people particularly are asking some pretty good questions. Okay, we're a high tax nation, very high income tax rates, very high capital gains tax rates now. I think people could cop that if it was offset by a big program that drives productivity and economic dynamism and growth. But there's none of that. And I think that's what business people are frankly pissed off about. High taxes and sacrifices are okay if there's something else coming through to grow the economy. But instead, we've sort of kicked over this housing leg of the stool, and it's not really clear to me, and I think lots of business people, what comes next. We had Ryan Stokes, CEO of SGH, the big conglomerate. He's now saying the cost of capital's changed as a result of this budget. I'm going to look at investing in the US. I think that's a bit of a warning sign. It's a hot topic. There's a great irony that, as always in Australia, everything comes back to housing at some point, doesn't it?
Yeah, absolutely. Now, we've had a stack of questions, James. Let's just work through a few of them here. I want to start with one from Gabe, and this is probably the most common sort of question we've got.
Yeah.
We've got a few of these. He says, I love the pod. I'm 18, hoping to build a career in finance. My question is on the CGT reforms. I'm a full-time student earning below the tax-free threshold, so I pay little or no tax on small capital gains. From July next year, young investors like myself could face a 30% minimum tax on real capital gains. If young people are using ETFs in the stock market to build wealth and eventually get into the housing market, doesn't this risk punishing the exact people the budget claims to help?
Yeah, I think we had an extension on that question from Nick, who's a millennial listener. They're the 30 to 45-year-olds who made the similar point. His generation was locked out of property, so they turned to ETFs and startups, and now ETFs and startups are going to cop a higher tax rate. I think it's a reasonable point, Anthony. I think there's relatively broad agreement that changing the dynamics of the housing market is a good thing. The question is, do we also need to change the dynamics of other asset classes? Do we need to make it harder for small businesses to attract capital? Do we need to change the dynamics in the share market where, you want to invest less in growth companies and more in mature dividend producing companies? I think those are reasonable questions to be asking, and I think the government is going to face some reasonably heated debate on those over the next little while as they try and push these changes through Parliament. Is the debate going to be nuanced enough to pick up on that idea that we need a different treatment for asset classes, though, Anthony? That's the question I still have.
Yeah, I think, look, at the end of the day, trying to make some reasonably passive money here in the stock market, I'm not sure the government's going to buckle on that one. I mean, if it does buckle, it seems to be more likely to buckle around the active risk takers, your founders and everything that maybe are putting more on the line, employing more people, founding the business, that sort of stuff.
Yeah.
I think at the end of the day, Gabe, like the government wants you to be a good wage slave, earn a good income, pay your 45% income tax plus 2% Medicare levy, save your deposit the old-fashioned way, pay tax on the way up. That's kind of the way it has been, and I think that's what they're trying to protect. But I can totally understand how in his situation, it feels like this budget's just out to get him.
Yeah, well, and I think some of these questions, and as this was said, they were picking up on some common threads, feel like the government's listened on housing, but then sort of whacked these generations on the way down. Andrew in Queensland says, do you think the budget will increase residential rents in two ways, the withdrawal of investors and supply, and an increase in rent by remaining investors? For years, Australian investors wore losses because they were able to negatively gear against salary and wage income. As that rolls off over time, will rents rise to cover expenses and be high enough to at least break even?
Yeah, I mean, you can kind of see the logic in that one, can't you, James?
Yeah.
I mean, you'd think the number of houses that are available for rent out there in the market over time should go down. I mean, the negative gearing changes are grandfathered. So, I mean, that's trying to prevent like a rush of investors selling straight away and taking that rental stock out of the market. Meanwhile, you'd have to think that demand stays pretty steady in terms of the people that want to rent, even though these changes are about trying to fix housing affordability. I mean, I think it's going to take quite a bit to really change the dynamics on that front. At the end of the day, though, Andrew, I think we didn't hear too much about the renters in the Treasurer's budget speech, did we? So unfortunately, the renters are probably further down the list of priorities here. Now, Treasury did say there should be a minimal impact on the rents and the rental properties, but it looks like it's going to go against renters a bit.
Yeah, I think that's right. I think you raised some good points. And as you say, Anthony, the budget does foresee a small increase in rent. So I think they're talking something like $7 a week over the next decade. They think the impact is going to be fairly limited based on their modelling. I guess we'll see if that's right over time.
Yeah, James, Dean from in Victoria, like yourself, says at a structural level, the budget appears to be positioning Australia for three things. Number one, investment away from existing residential housing, which is low productivity. Number two, reducing spend on the NDIS funding, arguably also low productivity. And number three, reducing the Commonwealth's reliance on the taxation of labour. I've heard the Chooks talk about the need for more productivity and the concerns of an AI Armageddon a few times. Is this budget, therefore, at least 3 steps in the right direction?
Yeah, I'd take Dean's point. You can make the argument that those are 3 steps in the right direction. But it's the other part of it's the other side of the coin that's missing here, Dean. You can do part of this, but then you've got to say, all right, here's the ways we're changing the tax settings and government spending to try and incentivise this type of behaviour. Where's the program to drive productivity and growth and economic dynamism at the same time as we're asking some Australians to sacrifice more? Yes, those are steps in the right direction, but they've got to be matched with the sort of reform that Jim Chalmers was talking about at the Economic Roundtable less than a year ago. And that's the opportunity that's been missed. And I think that's where the frustration of the business community in particular is red hot.
Yeah, there's a bucket load of money tied up in housing, and that's not necessarily productive for the country. I think there's still going to be a bucket load of money tied up in housing, even after these changes. And the actual home, like the one that you live in, your primary asset, that's looking like an even better investment now than it's ever been before, right? There's no tax on that.
Yeah,
so that's
true.
great. You're going to have a nicer place to live in if you put your money there. But once it's built, it's not really doing anything for the country. It's not doing anything for anyone else. I mean, that's kind of one of the big problems I see with this budget.
Yeah. One from Mark in New South Wales to finish, Anthony. The one tax that directly targets intergenerational wealth transfer, an inheritance tax, hasn't even been mentioned. Not rejected, not debated, just absent. Structure it sensibly and the ejections fall away. Exclude the family home. Set a threshold of, say, $2 million and everything else. Family farms are shielded. Ordinary households are untouched. Unlike income or capital gains tax, it creates no drag on productivity and no penalty for earning or investing during your lifetime. Why not put it on the table?
Politically extremely hard, Mark. Everyone out there, like it or not, we're all going to die one day. Everyone's going to either leave something or not leave something to the people behind. It would touch so many people. Directionally and in theory, absolutely. I mean, this is one way that we really could make a difference and one way we could change the tax base a bit and like you say, go after the assets and wealth from people who are passing away and trying to pass it down to their families. But I mean, politically just incredibly hard. I mean, any notion of a death tax, I mean, that almost seems untouchable at the moment, I'd say.
Yeah, you said the words, Anthony, the magic words, death tax.
Yeah.
I think, Mark, this will eventually have to be considered. Inheritance taxes are common in every other part of the world. They were common in Australia till the 1970s. And I think as we see the economy shift and change in the next 30 to 40 years, I think at some stage they'll be back on the table. But you're right, Anthony, they are very politically unpalatable, and it will be a brave government that touches them. Anthony, we should say thanks to all our correspondents for writing in. We had some great questions and we just wanted to summarise a few, bring a few together because, as we say, the budget remains red hot out there and we'll keep following the fallout as we go on. But for now, we'll come back after the break and look forward to a very big Wednesday. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Now, Anthony, there's lots going on next week, but I just want to focus on one day, Wednesday. I'm going to be in Perth for the AFR's annual mining summit, which is always great fun and comes at a really interesting time for the iron ore and critical minerals sector. So I'm really looking forward to that. Wednesday, in the middle of the day, we get the monthly inflation data, which is going to be crucial for the RBA's thinking, isn't it?
Absolutely, James. This is the hottest data release of the week for sure.
And then, because of such a big day, we'll all need a drink. So we'll tune into the Investor Day of Endeavour Group, which is, of course, the owner of Dan Murphy's and the owner of hundreds of pubs around the country. It's now run, Anthony, by Jane Herdlicker. She used to run Virgin, A2 Milk before that, and Jetstar before that. And, of course, she was the president of Tennis Australia as well. But this is sort of her big reveal, isn't it? She's going to let us see what her strategy for turning around Endeavour Group is.
Yeah, Jane's come in. She took the reins at Endeavour Group on the 1st of January, having been appointed mid last year. I mean, she's had a few sort of trading updates and what along the way so far. I think she's dropped a few breadcrumbs telling us there's not going to be any massive structural changes.
Yeah.
But this is a business that's in decline, really. Like the share price hit an all-time low this week. I mean, she's got a lot of work to do to turn it around. Hopefully next week, investors will get, a better idea of exactly how she's going to do it.
Yeah, it's fascinating, Anthony. I actually saw during the week a note from a ratings agency, one of the big ratings agencies which looks at the creditworthiness of companies around the world. And they were even saying there is a wine glut around the world because people have stopped drinking, basically, and this industry is in structural strife. So a bit of that flows through to Endeavour Group, doesn't it?
A lot of it does.
All right, well, we love questions here at the Chanticleer podcast, so if you have a question you want to send in, you can email us at chanticleer@afr.com. You'll find the link in the show notes. Of course, you can send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And there's also a widget on the bottom of every Chanticleer article, so you can also send in a question that way. As we said, thanks to all the correspondents who sent in questions about the budget. We really wanted to rattle through a few of those. And a special shout out to our friend Vin know, who wrote in to tell us that he listens to the podcast while he's at the gym or doing the ironing, Anthony, and it's firmly part of his routine. So I didn't know the Chook podcast could help you do your ironing, but there you go. We can do anything here.
Get some non-iron shirts, Vin. It'll change your life.
Well, Anthony, another big week looms. I'm off to Perth, and I'll come back with lots of tales from the wild, wild west about where our mining sector's at.
Yeah, enjoy hanging out with all the personalities, James, and you'll fit right in.
Thanks, everybody. We'll see you next week. If you like the podcast, send it to a friend, as it helps others find us. And don't forget to follow wherever you get your podcasts, so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business, and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin. Head of audio is Alex Gow, who also composed our theme. And the head of premium content is Fiona Buffini.
The Australian Financial Review.